how to manage risk, your feelings towards your investing, and ultimately your comfort zone that wraps around everything that you do, what limits what we will take action on, and ultimately limits the wealth and income that we can create for ourselves. How is your relationship with debt and how you feel about it?
Welcome to Perth Property Insider, where you will learn how to grow your wealth and improve your life using Perth property. Our show is brought to you by Investors Edge Real Estate, the highly rated and award-winning property management, sales and buyers agency servicing the whole of Perth. Now, here's your host, Jared Mann.
G'day and welcome to another episode of Perth Property Insider. I'm your host, Jared Mann, and today I'm going into a topic which I think is critical to the success of any property investor, and that is how to manage risk, your feelings towards your investing, and ultimately your comfort zone that wraps around everything that you do and is always, for each of us, what limits what we will take action on and ultimately limits the wealth and income that we can create for ourselves. So after now doing lots of strategic plans for clients, I've gained interesting insights into how the typical investor thinks and what might be holding them back. And that's the benefit of working so closely with so many of our clients. Now, a strategic portfolio plan is not just a plan to buy properties and create a portfolio. And I've said this before. It's so much more than that because it helps you grow that comfort zone and the capacity to become wealthy, which I think is even more important and is definitely the limiting factor for everyone. So how does it actually do that? Well, when you have to plan forward into your future and you start seeing what you could be worth for equity and what sort of passive incomes you could earn, for a lot of people initially, that can make them feel anxious, can make them feel like, oh, is this really even possible? So you have to actually get used to it in your own head, and you can step forward from the future into today, the actions that you need to take in order to realize this much better future. And I liken it to the person that wins lotto and just ends up with the money straight away. They don't have a plan for it. The money's outside their comfort zone. They're not used to it. And we've seen from the stats that the typical lottery winner divests themselves not only of all their money, but all their friends within a short period of time. So having a strategic portfolio plan for me is more about altering and increasing your comfort zone and that capacity to actually hold, keep, and be wealthy. So even the most successful investors have got their own ceiling or comfort zone, and it's something that I play with continuously because even my comfort zone, if I'm chatting to a more successful investor, potentially an older one that's been doing this 40, 50 years, that's accumulated a lot more wealth, well, some of the things that they might tell me might blow my mind and really be outside of what I'm comfortable with. And we're all somewhere on this spectrum. There's always someone further ahead than us. It's not necessarily a competition against other people. It's more about what goals do you want to achieve? What are your dreams? And unless you continue to push through this comfort zone that you have, then you're going to limit yourself and fall short of those things. So important when, life gets in the way, when things become difficult, you just default to what's in your comfort zone. You don't keep pushing. And something that I think I've done well over the last 20 odd years in investing and 16 odd years in business is continuing to push through those barriers. And then when you look back, you can't have even imagine what was possible for yourself. And that's why I also keep updating my overall strategic plan every year and, resetting my dreams, resetting my goals and working out the steps to take this year to get there. So I've been pondering, well, what is the difference between pushing too far and potentially taking on too much risk and compared to what a more sophisticated way of thinking might be? So to one person, things can appear risky, especially when you're stuck inside your comfort zone. But in reality, what that person views as safe, I could actually view as risky. Let me explain this. The use of debt always brings up a whole range of feelings, mostly fear, anxiety, and weight. And I think it's the debt that most people are worried about as part of investing. But we need that leverage in order to effectively grow our asset base and set ourselves up to have that passive income down the track. So we all have to become a friend with debt and change how we perceive it. So a lot of other people I chat to are waiting until their house is paid off to invest because they perceive that to be safer. They want to reduce their risk in their minds, and they think that having the house fully paid off before they start investing is going to be the safest way to go. So in my mind, what is actually risky is waiting so long to invest and being so much closer to retirement. By the time you've paid off that house and gotten around to investing, you don't then have the decades needed for rents and your property price to compound and create that massive wealth. So when you start late in the game and you put it off until your house is paid off, you almost then need above average returns. It's that panic moment that shit, I'm not going to have enough for retirement or having those choices and transitioning. So I need above average returns. Whereas when you start early on, you push that comfort zone, and what you think's possible for yourself, you've had the time for things to compound and create that wealth. You don't need above average returns. You can just have average returns over a longer period of time, and it's going to be mind-boggling as to what you'll end up with. So it actually decreases the risk, because if you get a period of time where the market doesn't do things, if you get a setback in your world, you've got that wealth behind you already and you've got the time to wait it out. So I also perceive it to be safer to have other assets other than your home working for you while you sleep. Like I just mentioned, if you ever run into trouble then and you need a large amount of money for an opportunity perhaps as well. So it's not always trouble, it might be for an opportunity with your business or with other investing. You've then got your investment properties to potentially look at selling or refinancing some value out of. And hopefully by that point, they've gone up in value. So otherwise, in the case of just having your family home, well, that's one egg in one basket. You run into trouble. Hopefully you've got the money in offset as a bit of a protection, but you've really only then got the one option of selling that family home and where are you going to live in that case. So I perceive it as being less risky to have eggs in a few different baskets all working for you, and that flexibility to look at selling part of your overall asset pool as opposed to the one place that you're living in. So this was the case for me when I started my business. I needed to raise money. I sold up a few properties at that time. This is back in 2008, which sounds a long time ago now. I also then needed to raise money later to buy my business partner out, and this was 7 or 8 years ago. So at that point, I completely sold everything, and we had a joint property together. So completely sold up everything to pay her out and take that opportunity, everything except the family home. So we've kept that as an investment as we've moved out from it, and as we've upgraded, we've kept our homes and always sort of bought our properties with a bit of an investment mindset to it. So it was great to have that other equity, that other wealth that I could realize and use to take those opportunities. So others also perceive it to be safer to buy one property. And this is, what I hear every day. I'm going to buy one property now, see how it goes for a few years, and then look at buying another one. So I just look at the stage of the Perth cycle and think that that's risky. So we know that it's a really great time to buy now. We know that there's likely to be a lot more upside over the next 2 to 3 years. So why would you, if you could buy now, why would you defer that and to see how your current property that you've bought or current portfolio is going to go? We know it's going to go very well. It's only if there's a big spanner thrown in the world economy that it might not, but the odds are in your favor. The odds are not so much in your favor if you wait till prices are much higher and your first investment's gone well, so you get into another one. By then you're going to be sitting for a little while potentially Yes, you'll have more options, more properties on the market for sale to choose from, and you can choose a better property. Might have a bit more negotiating power, but you're not going to get that upside potentially for a while. So if you can buy 2 properties now or 3, then why wait? And it really does come back to creating that strategic plan and seeing how many you're going to need and over what sort of time period, and does it actually fit with your plan, not just randomly going out and buying them. But with the market going so well, they're very sure to get growth on all your properties, and that equity and rental price gain is going to then insulate you for later when the market eventually does come off the boil. So get in now, your gains, get a bit of equity in there. If things did ever turn to crap, you're insulated, and you're going to get some decent rental price rises to help make the property much more positive as well. And those 2 things are going to insulate you for when the cycle does come around. Now, we have clients who, as part of their strategic plan, we were looking at buying 3 properties over 5 years. And I'm thinking of one client in particular when I'm talking this through. And with our focus being on selecting suburbs that are most likely to outperform with our buyer's agency, and really putting a very deep analysis around with what we use called our trifecta review, where we look at the suburb, the area, and the property. We really want to, have the best chance of a property outperforming in the short term and in the long term. For this particular client that was planning to buy 3 properties over 5 years, we have bought a property 4 months ago. It's already increased significantly in price by $90,000. And that increase has enabled them to progress their plan much faster. And rather than purchasing 3 properties over 5 years, we've just bought the second property for them, which is an off-market deal, really great cracker of a purchase. And I'm very much seeing the way that things are going before we've even settled on it, that in 4 to 6 months' time, he's going to be in a position to buy his 3rd property. So what can progressing your portfolio that quickly do? He's shortcutted what could realistically have taken 5 years into less than a year. He's got an upside on the first property, a decent amount of upside. He's going to likely be set up well for the second. And I think with the amount of growth ahead in the cycle, if we purchase the 3rd in the next 6 months, there's still going to be decent upside. All 3 of them growing for him now. And obviously, you've got to look through to your plan, make sure that you can afford the holding costs. And in this case, his bottleneck was not having enough deposits. So he had a reasonable income, good amount of savings, able to afford the shorter term holding costs until the rents increase over the next year or 2, and interest rates likely will decrease, improving his overall cash flow position. And he's probably 4 to 6 months away from adding that 3rd purchase. Now, I'm sure to some, even potentially listening to this would seem incredibly risky. But to me, this seems like we've reduced risk, especially when we consider the bigger picture. So when you consider the debt and the amounts you borrow, many would like also to use their cash and I guess try to minimize that debt that they take on when they make a purchase. And so they often put every single dollar that they've got in their savings into the deal that they're purchasing. And this can leave people living on Maggi noodles for a while, and especially in this high cost inflationary environment, cost of living's going up. If you put every single dollar into your investment purchase, it is potentially going to leave things very tight. So, however, most investors in Perth now actually have the equity in their properties. They don't even realize many are sitting on 50% equity. At the very little, they've got an extra 20% in equity that they could draw out. So why not preserve your cash, keep it as a buffer in your offset, and use your equity to fund your deposit and your purchase costs? I perceive that as a safer way to have cash available for those rainy days, for the hot water system blowing up, for buffering any other unforeseen cost that comes up, and having more debt that is tax deductible and taking an interest-only loan on the whole lot for a 5-year period, giving your properties a good chance to increase their rents and get to being neutral, if not slightly positive over that time. So rather than putting all your cash in, leaving yourself tight to the max, I would look to use the equity in your property and reserve that cash as to insulate you. So which one of those do you perceive to be more risky? I perceive preserving your cash to be less. Yes, it involves taking on more debt, and it really goes to how is your relationship with debt and how you feel about it. And ultimately, that's that comfort zone that we're talking about. So this all does come back to having a strategic plan and what age and phase of building wealth that you're in. And when I do these plans, I also see how much harder it is to buy investments in 5 years or 10 years. When I'm modeling things out, only a modest amount of growth between now and then makes it so much difficult to purchase that property. So what might be $650K today, when you project things down the track and you're looking at an 800 or 900 purchase with only modest growth over the next 5 years or 10 years, it's going to be really difficult to build the portfolio. So what's more difficult? Stretching that bit further today, stretching your comfort zone a bit further today, you'll be glad that you did, or having to stretch much higher in price, it being, when you got a higher price and a similar yield, then you've still got a higher net cost to yourself per year as well. Hopefully you followed that. So getting in at a lower price, even if it has the same yield, you're going to have a less overall cash shortfall if you can get in today. And I get the value of $1 today is worth more to you than down the track. But, I just encourage people to make the most of this boom period and get in for a cheaper price now. And ultimately, the longer you wait, the higher the price and the harder it's going to be to get in, unless you have a significant jump in your income to help with that. Now, if from this episode you're feeling a bit of anxiety creep up, I've talked about debt and the different ways that I perceive risk. Listen to that feeling and that thought, and that's what I try and do with myself. Recognize that that's the edge of your comfort zone, and it's the thing that is protecting you. So we do need to listen to it, but it's also the thing that's holding us back. So look to find the right professionals, look to get a strategic portfolio plan. We can help with that and the execution on your buyer's agency. De-risk things those ways and some of the other ways I've mentioned in this episode, and look to push through that comfort zone, because I think future version of yourself is going to look back and think, gee, I'm really glad I did. Thanks for tuning in. If you like this one, give us a share or a rating, and I'll catch you on the next one. Just a reminder, the information discussed in this podcast is general in nature. As we don't know your specific situation, you should always seek professional advice before taking any action. For free market reports on your suburbs of interest and other helpful resources to grow your wealth, make sure you join my property investor update at investorsedge.com.au/join. And finally, make sure you're a member of our Perth Property Investment Facebook group to be part of the conversation with other like-minded investors, get help to your questions, and get a feel for what's going on out there in the market. I'll see you in the group.